Welcome, everyone. All right. The talking into the mic didn't work, but I did walk around and literally force people to sit down, and that works better. It's a good lesson. Okay. Good crowd here today. Thank you all for coming out early to have this wonderful investor breakfast. This is our second of these breakfasts that we've had, and we're going to continue to do them on this kind of cadence. You might think that, talking about our investments and having these on a regular cadence would be repetitive, but apparently the world has something else to say and can be quite dynamic, so there's lots to talk about probably every time. And our friends from FEG are here to do that. But first, I would just like to welcome you all here as our fund holders, from our agency funds, as well as DAFs and other fund holders. We appreciate you being a part of CACF. My name is Jake Zarnagar. I am the governing board chair of CACF. I know a lot of board members are here as well today, so please find us and chat with us anytime after our official program, which won't be too long. So there'll be a lot of time to mingle and eat and have coffee after this. Last time we were up here, we talked about that we were going to be introducing some new investment offerings, some new fund offerings. I'm happy to say that we have accomplished that, and you'll learn more about them today. Things that are more values aligned, as well as aligned with some of our investment strategies as well. So CACF is making changes and growing and new offerings for you, which you'll learn about more today. I don't have anything else. I would just like to say thank you and introduce our CEO, Leslie Lynn Smith. Thank you.
I was told, that it was hard to hear Jake and that I should pick this up. I also was downtown on the mall last night seeing Graham Nash, and I feel a little bit like a rock star, so forgive me if I break out in song. It was a great night out on the mall. Thank you for being here. This is our second investment breakfast in a year. We're excited to be back with our partners from FEG, with our team, with our board, with our community members. I love this day. I love every time I get to be in community with all of you and think big thoughts and dream big things. So thank you for taking a little time this morning at a very early hour to come out to this very beautiful place in Charlottesville. I'm excited to see you. As Jake said, we have been busy at work over the last 6 months doing a bunch of things to really advance our capacity to lean into our mission, which is to improve the quality of life for all members of our community, and most especially those who have been negatively impacted by inequitable systems. And it is through our collaborative efforts to pool our resources, help them grow over time with the support of FEG, and then deploy them strategically into the community that we can improve all elements of community vitality. And so this is no ordinary investment breakfast. This is an investment breakfast about impact, and we're really excited to be here with you to talk about that. A few things we've been working on over the last almost year since I arrived in June of 2025. One is our first pillar of effort at CACF, which is all about building and maintaining a strong enterprise. And in order to do that, we have to listen and learn and innovate. And all of you have, over the course of years, shared a lot of information about what that can look like. And so thank you for being our thought partners in the development of some of the new products that you'll hear about, and over the course of the coming year, some of the things that we're going to be advancing in and around matters of community vitality. We're also really focused on catalytic resources, all of which are currently being discussed today, and ensuring that we are strategically growing those assets in a way that allows us to expand and elevate our impact across the community. It's no surprise to anyone here that things are difficult for members of our community, and the things that each of you are doing in your organizations and in your individual lives are really designed to invest in humans and place and ensure that things are a little easier for all of us. And so Terrell White on our team and a number of you who have agreed to serve on our Strategic Growth Committee are really going to think about how we grow these assets and create more opportunity for expanded impact. We're also working on deepening our relationships across the community. At CACF, we talk a lot about being in the arena. And being in the arena means being there when things are joyful and celebratory, like, you know, when Graham Nash is singing to you late at night on a work day. And when we're trying to solve matters of the unhoused, or folks that don't have access to health care, folks that need to understand our history better. And we want to be in those conversations, all of those conversations with you as full-throated, humble partners, and ensure that we're facilitating and pooling philanthropy in a way that supports those efforts. So thank you for investing back in us and pouring into those relationships. And then finally, we really want to focus on influential leadership across our community, but also across the nation. Through our data and collective impact tracking, we know that we can help other communities sort of meet the challenges of today. And I think we should take a point of pride in some of the really innovative things we're doing as a community. And I think sometimes we get really stuck in the things that don't feel good or could be better. But the reality is, thanks to all of you, many things are improving in Charlottesville. And for that, we are grateful. We've also been growing our team to ensure that we can meet the demands of this moment and moving some of our team members around into new provocative impact roles. And so I'm going to try to run through all of those. And if, as I talk about you, I'm sorry, you would stand, please. Terrell's already standing. He's not new, but he is in a new role, fully focused on strategic growth for the enterprise, which means growing our assets under management, growing our endowment, and ensuring that we are able to live in perpetuity, making an impact here. We also have Valerie. Where's Valerie? Valerie, she loves to stand. Stand up, girl. Valerie has been with us a long time and has recently agreed to move into a new role at the foundation in our philanthropic engagement team, where she's going to help sort of organize and advance that work, make sure that we are covering all matters of impact and doing it with a level of efficiency and excellence. So thank you. You can sit, because I know you're really mad at me that I made you do that. Chaz Manning, please stand up. Chaz recently joined us and is leading innovation and administration to ensure that we're thinking about all of the things that we can and should be doing in the world. Heather Enos, please stand. None of them were warned about this, so this is great. Heather is our new Chief Finance and Operations Officer, who we've brought in to really professionalize our efforts in those departments and ensure that we're moving forward with transparency and efficiency. And as we talked about when we were together last fall, we were having some challenges with that. And I'm really excited to say that we're moving forward in many really provocative and important ways. We also have a couple new people on the community impact team, Michaela and Jay. I'm talking about you. Hello, ladies in the back. We are so excited. This is day 4, I think, for these beautiful humans who have come to support our efforts in community impact. Furthering the conversation on community impact, Megan Donovan, who many of you know because she is a wizard at a million things at CACF, has taken on a new portfolio where she is now leading our application-based grant portfolio. And so thank you for your willingness to step up and stretch. And then last but not least, Daniel is already standing. Daniel is now leading our solidarity portfolio and capacity building efforts, which are all of the ways that we as an organization invest back into the nonprofit ecosystem in the the community. So thank you, team. These are the awesome people that are doing the really difficult work every single day to ensure that your dollars are being felt in the community, and we are all celebrating more vibrancy as a part of it. Just want to sort of anchor us finally in the values that we bring to bear as we move through the world. Curiosity. I hope you will spend this morning being curious about what you're hearing and thinking about the ways that you can further engage with us and FEG. Truth. We are here to be more fully transparent and clear about all of the things that are happening in the world and speak truth in all places we occupy. Proximity, we want to be close to you and all of the things that are happening in our communities. Solidarity is a fundamental commitment that we make to each of you. And repair, for any of the ways we've harmed you or any element of the community, we want to work on repair, and we will continue to do that. So please know that we are doing the work internally to continue to gain your trust, your partnership, your confidence. We are grateful that you are here. We are grateful that you've invested with us, and we are excited to do this really important work with you. So with that, I get the unique pleasure of introducing the people you actually came here to hear. Alan and Catherine from FEG. You know, the last time we were here was the first time you were meeting them. In the time since, many of you have met with them individually. That remains an open opportunity, and please talk to me or Keisha Bwenge if that is of interest to you. But they're here to talk about not only our collective investments, but a little bit about the world and what all of that means to those. So thank you for coming in from Cincinnati yesterday and maybe this morning, okay, to be with us. And without further ado, I'll hand this over to them.
Great, thank you, Leslie. And good morning. Again, can you hear me? Is this working? Okay. Again, I'm Catherine Maurer, FEG. I recognize a lot of familiar faces, so it's great to see those of you that I met before again. It's great to meet new people as well. You know, it's been a pretty incredible year. Geopolitically has been off to a crazy start, so I know there's probably a lot of questions, and we are going to take that time to address the questions. We're also going to leave time at the end for Q&A. But first, we want to really start by reintroducing ourselves, talking about how performance went. We have been with you all for a little over a year. We now at least have a year of performance that we can claim is truly FEG's, and we'd like to share that, talk about the environment looking forward and what we are doing to manage the current state. So with that, once again, Catherine Maurer, just for those who don't know me, I'm the lead advisor. I've been with FEG for 20 years, and I am joined by, thanks. Alan, are you good at it?
Yes. Thank you very much for having us this morning. Alan Lenahan, CEO of FEG. Great to be with you again after, as Catherine mentioned, a very strong start to the relationship. And thank you, Leslie and Jake, for kicking us off this morning. I'll give you kind of the brief overview of FEG. Where's Larry? I had just enough time to chat with Larry, who said, why are you working with the Community Foundation? Why are you in Charlottesville? And I think it really does come down to our profile and the focus of FEG aligning extremely well with what Leslie was just talking about. We are headquartered in Cincinnati, but we work with over 40 community foundations. FEG was founded because we wanted to bring independence and objectivity and an exceptional investment experience to the clients that most deserve it. And for that, we love, everybody individually needs to take care of their wealth and those types of things, but we focus our time and effort working with nonprofits. Over 90% of our clients are nonprofits. That's our core area of focus. It's why we were founded. It's why today as CEO that I believe we should stay in that lane, because we get to hear about these wonderful missions and really bring some impact even if it's just from a results and a performance standpoint, but bring that impact that we know does great things for the world. So I think that's why you all hired us. It just so happens we've also put up some very good numbers, which we'll get to. We manage 100 billion, which actually compliance would never let us put a number up there that wasn't exact down to the dollar amount. It just so happens that got to $100 billion on the nose, and that puts us kind of in the right size for us to do what we do for you, which is make investment decisions, pick investment managers without overwhelming the market. There's peers of ours that manage $1 trillion. That's too much, frankly. You can't be nimble with that, and we like to stay nimble. So we're 100 billion, we're growing, we're coming off of the 2 best years in our firm's history of new growth. For us, that means adding some wonderful clients like the Community Foundation. And I think that's because of our focus and the results that we've been able to deliver for clients. We do have offices in Indianapolis and Dallas as well. A little bit more about our client base. Again, over 40 community foundations that we work with, about $9 billion of community foundation assets, and Catherine is a community foundation specialist. So she does the day-to-day work with you and has done that for 8, 10 community foundations currently. And she's also launched our Community Foundation Survey, which over 100 community foundations respond to, and gives us great insights to share with you, the committee and the board. So she's an expert, and it's a heavy focus of FEG's. And we've got a handful of clients that you're probably, you can't see those. But they're all over the country, Naples and Richmond and Wisconsin, and they're all different, very, very different, and have different needs, different community needs and impact efforts. But there is a consistency in how to design portfolios, design options, customize what we do to the mission of Community Foundation that Catherine's an absolute expert on, and we're bringing to you here. So maybe that's a transition into the portfolio options.
Yeah, no, that's probably a great transition. I think I got it now. Okay, so last time we talked, we mentioned that we were thinking about expanding options for you all. Historically, you had 2 portfolios you could invest in. There was a long-term endowment, and then there was a short-term, very short-term, more like cash-like pool. That's happened, as Leslie mentioned. We were able to add 2 new portfolios, and I want to walk through each of the offerings because it is important that you're aware where you're invested and it's meeting your needs, not just now and historically, but in the future, because needs change. So if you don't mind, Alan, going to the next slide, I'll just take a couple minutes on each. Long-term portfolio. Now, while this portfolio is not new, we did work closely with the investment committee last year to really think about the asset allocation. And we made some changes to the asset allocation. I would say the biggest change is more diversification. And that's going to be important as we kind of jump through what's going on in the market right now. So that portfolio is currently intended if you are investing for at least 5 years. Don't pull out more than your regular withdrawals, distributions. But really, this is meant to this is meant to last into perpetuity. It'll give you the most consistent distributions. Then, if you go to the next portfolio, this is a new one, intermediate term. This allocation is 60% fixed income and 40% risk assets, which are equities and real assets. So this is good if you are thinking you might have some needs in the future, maybe 3 to 7 years in the future, but you don't have immediate needs beyond some normal distributions until that time. And the short-term portfolio is really for anything less than that. So if you know you're going to be spending down cash quickly, this is the place to house it. It's still a good time to be invested in cash. We'll talk about that in just a minute, too. And this one, I think, is where we received a lot of questions in advance. Thank you all for the questions that you sent ahead of time. That was really helpful. This is the socially responsible portfolio. So this is an option if you want to align your investments with your values. It's called a double bottom line. And it mirrors the risk profile of the long-term portfolio, but it does have a little less diversification, so it can be a little more volatile of a portfolio. But I'll tell you a little bit about what those values are, because values can mean a whole lot of different things to different people. So in this portfolio, it's really, you're thinking about the environment, care for our common home. So what that means is you're leaning into companies that are being responsible. They're monitoring their air pollution, their actual pollution. They're using non-renewable resources efficiently. And you're avoiding firms who have had repeated pollution violations. Governance, that's important too. And again, leaning into companies that have ethical business practices, transparent governance. But then you're avoiding firms that are operating in sanctioned or dictatorial regimes. And then lastly, social values in this portfolio mean some exclusions. And it's impossible with a values-aligned portfolio to hit everybody's values perfectly. So when I read these exclusions, some people may not, may be fine with that. But overall, this portfolio has broad appeal and can get you closer to your values. And so again, the social would be excluding alcohol, tobacco, gambling, pornography, predatory practices, and weapons. But then leaning into other organizations that demonstrate human dignity, equitable labor practices, and diverse leadership. So I took a little time there because we had several questions on what this portfolio meant, so I wanted to address that. But now we're gonna look backwards at your performance. We were able to get performance through the end of March, so unless we tell you otherwise, everything we're talking about is through the end of March.
So this is just the market return. We'll get to the results in your portfolio. And since it's March 31st, it's very dated and near the weakest point for markets for the year on that orange line. If you do fast forward to now, all those orange lines are actually positive. The S&P closed at its all-time high yesterday. So a very difficult headline environment we've been in, but if you look back, I think about a year ago, we were here, it was a similar situation, and it seems to be maybe a pattern that's developing with our current regime, that we're gonna have a really noisy spring, and you have to look through the noise and stay invested. We'll get more to that as we keep going. But another thing to point out, all the blue lines and the gray lines, this is 1 year and 3 year results from these different markets, and it starts with equity on the left, with the global equity market, and fixed income in the gray, S&P real assets. You have about a 5% holding in the real assets portfolio, and then a hedge fund benchmark. Regardless, they're all out, they're performing extremely well on an absolute basis. Markets are up. This has been a great time to stay invested and be invested over really a year to date, a 1 year, a 3 year, a 5 year, a 7 year. It's been a tremendous risk on market. And we'll talk about the sustainability of that a little bit, but it has resulted in really strong performance for your portfolios.
Yeah. Okay, thanks. So I'm showing performance for the 2 portfolios that have been invested for this time period. The other 2 are newer. They don't have a long track record yet. So let's start actually on the bottom and then go up. So the bottom is the short-term portfolio. I know it's hard to see, so I'll read that out here. Despite the volatility of the quarter and all the headlines, your cash portfolio was steady. It returned just short of a percentage point. This is just 2026. If you look back over the past year, it returned 4%. So you're still in an environment, even though the Fed cut rates and that influences how much you can make on cash, you are still in an environment where you can make, I think it's 3.6% on cash right now if you're in money market funds. Right now, that looks like it's holding steady. The Fed, when we started the year, we thought there would be a couple further rate cuts. Now we might even be looking at 1 rate rise at the end of the year. We don't know yet, but that's what the market is thinking is possible. So Still a good place to be in cash. So if you have allocations in cash, it's, I mean, you can expect 3.5%, I think, at least this year. Now, looking at your long-term portfolio, year to date, again, this is where you have a lot more stocks, a lot more equities, a lot more exposure to volatility. You've got exposure to AI, and yet your portfolio was only down negative 0.6%. So again, with the volatility that we saw in March, we were actually pretty pleased that your portfolio stayed flat. Your portfolio will move in the direction of the markets. It has that exposure, but we like to see it when it doesn't move all the way with the markets. And this is versus a target weighted benchmark, which is our primary way of measuring whether or not we are doing a good job as your advisor. Your target weighted benchmark returned negative 1.9%. So you were ahead of the benchmark. That benchmark is set by the investment committee. It does not change frequently. It's, and when it does, it's a big process. So this is not, something we move around to make ourselves look good. This is what we are holding ourselves accountable for.
You're not going to talk about 16.9 versus 13.8?
Oh, that's a better number, because that's our number. Good point. So this is, we can actually feel it. Last time it was another advisor's performance and work, and we are really proud of this number to return almost 17% for you in the last 12 months, ahead of a benchmark of 14%. And that's not easy to do. That's actually a little ahead of what we intend to do with the way we design your portfolio. And there's really three reasons why there's three main reasons, and I'll just talk about those for a minute, and I think it'll help you understand the portfolio. This is a complicated portfolio. But the first reason is active managers. This portfolio blends passive strategies and active strategies, and your active managers contributed to returns, dynamic overweight to small cap, and then allocation to gold and gold mining. I would say those are the three biggest drivers of outperformance for your portfolio. Speaking a little more on each of those, active management, you have 7 active managers. You have 13 funds in this portfolio. 7 of them are managed actively. Of those 7, 6 outperformed their benchmarks over the last 12 months. The one that underperformed was down by 0.1%. And some of these names, they were significant outperformance. You had, I'm kind of killing the gold story, but I was about to tell you, but First Eagle Gold Fund returned 89.5% over the last year, and that's in advance of its own benchmark, also a significant contributor to your portfolio. And then you have something like GMO Resources, which does have energy. It actually has a lot of clean energy in that fund, and that returned 69.9 versus a benchmark of 51.2. So I already kind of gave you the performance on gold. Gold is an overweight position. This is something, as your OCIO, we can look at your factors, underlying factors, and we look at these all the time, and we can make a decision to overweight them or keep them neutral. And for us to make a decision to overweight, it has to be high conviction. We don't believe in market timing. We don't do this very often, but this is one that we've had a lot of conviction in. Gold is interesting in that it behaves almost erratically. For the last year, it's benefited from the rates coming down and some insecurity around policy, the dollar, people, especially non-U.S. investors, investing in gold instead of the dollar as one of their standards. So those are all reasons why gold did very well looking back. But as you look forward, gold can actually be a really good inflation hedge and a really good diversifier. And then the last reason is dynamic overweight to small cap. Currently, your equity portfolio is all passive. In the U.S., it's very difficult to outperform, and so we do like to just keep the costs down where we can. But that said, we're not being passive as your OCIO, and we did dynamically overweight small cap equity. There's a couple reasons for that. These charts are small, but they really speak to growth and valuations. Just in the interest of time, I'll focus on the valuations. So this S&P 500 chart shows you're at about 19.4 times PE multiples, and the S&P 600, which is a measure of small cap, you're at 14.3 PE multiples. That gap, in our experience, tends to converge, and so this is a pretty good gap, and so a pretty good time to invest in small cap, and it has worked and helped your portfolio. I think I wrote it down. Small cap U.S. and non-U.S. trailing one-year returns were 21% and 33%, respectively.
So I just want to level set for a second before we get to the current market environment. Very excited to be here today because these numbers are, we set a bar here that next year when I'm here, we won't be able to live up to. 3 percentage points outperformance is on the absolute upper range of what a portfolio like yours could ever do. Everything went right in how we invest and the experience you had. If we can beat the benchmark over 5 and 10 years, we're happy. So it's a great start, but don't expect 3 percentage points of outperformance every year, please, or you'll boo me and us next time we hear it. It's been a great start to a great relationship. Okay, with that said, let's talk a little bit about the market environment. And I love how we start this because this is a chart of the last 30 years of the S&P 500, I believe. Yeah, S&P 500. And that's about the time frame that we think in. While we do have an overweight to gold and an overweight to small cap, they're small positions based on valuation and fundamental and sentiment analysis, and they're small, but generally the way we approach, well, always the way we approach investing is on a very long-term mindset. As Catherine mentioned, your long-term portfolio is meant to be a perpetual long-term portfolio that needs to outperform spending and inflation forever. This money's not going anywhere. It is here to take care of this community for generations. So we think generationally in how we invest. So when we talk about markets, I'm not going to. It's impossible not to talk a little bit maybe about the last 3 months or so, but we tend to think in 30-year time frames, not 3-month time frames. And this also goes to the exceptional results that we've had over the last 1, 3, 5, 7 years, because you can see the S&P 500, if we cut this chart in half, for the first 15 years of a 30-year backward-looking time frame, the S&P 500 was up 6.5%, annualized. Now that included the tech bubble bursting, and it includes the great financial crisis. But really, the last 15 years, equities, as displayed by the S&P 500, are up almost 15%. That's not sustainable. I don't want to create anxiety and fear, but that's not sustainable. The market, the building blocks of what equity markets can deliver never equal 15% on a long-term time frame going forward. So we've had a great backdrop. A lot of investors, one investment style is a technical charting kind of concept, and what they would do would be draw a line here, and it would come down to about here. If you just drew kind of the tops or the bottoms or the ranges that the chartists like to do, and that would say we're due for some correction. Markets have gotten a little ahead of themselves, and when you see spikes like this on a chart, you should have some concern, and we do, but not in the short term. We just know, and we advise our clients, if you're looking out over the next 10 years, we can't expect 15% forever, and the next 10 years will more likely than not be more difficult than the last 10 years. So we use that in input into our allocation decision making. Right now, we are fully invested. Your portfolio has been fully invested. The other kind of, maybe if you want to shorten the time frame, I think last time we were here, we were coming out of the tariff tantrum. This year, we've got war in Iran. These are very negative headlines, create a lot of emotion, a lot of anxiety. The tariff situation, markets fell about 15%. We use that as an opportunity to rebalance into markets because they became cheap. And it's barely a blip on here anymore, but it's this little this little blip down created an opportunity to rebalance back into markets. We didn't even get that opportunity over the last 3 months. Markets in March, as you saw, were negative for the year, and as of yesterday, they're already positive for the year. So our job as a long-term investor is to eliminate emotion, eliminate headlines from decision-making, eliminate the noise and the tweets and all the stuff that creates anxiety on a daily basis. Think longer term, stay invested, and make sure your portfolio is going to deliver a long-term result without getting sucked up into short-term noise and momentum. And that's worked for our entire history, and we believe for portfolios like yours, that's the right strategy going forward. So we've got a few other concepts here because, before the war, everybody was talking about the AI bubble and really concerned that we were headed for another tech bubble collapse and bursting. And there's a couple different ways to look at that. We don't believe we're in an AI bubble. I think this helps clarify why. The top chart is just the price to earnings ratio of the S&P 500. You can see in the tech bubble, it did get up to about 25 times. And today, we're actually close to that. And that's an aggregate broad market S&P 500 companies valuation level. So things look expensive, which they should when you see a chart like this where everything's been dramatically up over the last 10, 15 years. So in general, markets are expensive, but this is a chart of the NASDAQ 100 comparing valuations. So these are the large tech companies. It includes the Mag 7, the Googles, the Apples, the Nvidias, et cetera. In the tech bubble, that market was 89 times at its peak from a valuation perspective, and today it's only 26 times. So we might have a little bit of an everything bubble's aggressive, but everything's highly valued, but we don't see a very specific bubble existing in the AI or the tech names, which is positive in our ability to stay invested across the market. Part of that's because while we've seen the AI stocks run, they're generating significant earnings, unlike the tech bubble. NVIDIA's profitability is through the roof and annualizing, I think, over 100% profitability growth each year. So they're growing into valuations. That did not happen in the tech bubble. There were no earnings. It was all fake. Now we have real businesses generating real earnings. And what we're seeing is the semiconductor stocks have taken off and software is down. So you're seeing a balance. It's really just a rotation into AI companies, semiconductor companies, and the companies that are going to lose are going down in value. That's actually healthy. It's a traditional rotation across market segments. And when you look at a portfolio like yours that is fully diversified across, we're not betting on one of these versus another. We're building a broad portfolio that has broad allocation across sectors. This doesn't hurt. It's just a natural outcome, and we benefit from the blue line going up more than the red line goes down. Energy, of course, is another hot topic with, I didn't see it this morning yet, oil's been somewhere between $70 and $120 based on the headlines that we're seeing and whether the strait is open or closed today. But it can have a negative effect. Oil shocks can have a negative effect on earnings. And at the end of the day, with all the noise and everything going on, stock market returns depend on earnings of the companies over the long term. You see a lot of noise with headlines and risk and volatility, but over the long term, it's the discounted cash flow of the profits businesses generate that sets their price. So when something is going to hurt earnings, the market should adjust. When something is going to help earnings, it also adjusts. We've seen periods of time where operating margins have turned negative, and a lot of times that is because energy cost or inflation dramatically spike or go higher. We haven't seen that yet. If oil stays at $120, the energy sector will do well, and a lot of companies' profitability will be hurt. But again, it'll create a little bit of a balance. There will be a sector rotation, and the companies that are not heavily reliant on energy as an input won't be affected. But those energy companies, or the energy-using companies, could be negatively affected. Right now, we're at peak earnings, 19.4% operating margin in the S&P 500. That's partially why, that's a good bit of why the market has had such a good run. Positive earnings, growth in earnings, flows through, and you see great results. We don't expect that necessarily to turn negative. One of the dreams of the AI revolution is better operating margins, more productivity for the companies that are able to deploy that technology. We can have fears about the labor market. I've got 2 kids in college. I am very nervous about the outlook for employment, but for earnings and profitability, it will help companies very likely. This is diversification. Your portfolio should be diversified. It's easy when you look back for the last 15 years and you see 15% results from equities. Why don't we just own equities? Put it all in there. That's a very dangerous game. So we like diversification. In your portfolio, the real asset allocation is a great diversifier and a great total return benefit, especially for the last year. We will continue to have fixed income, especially for those shorter term portfolios. You do not need that volatility when you know you're spending the money. So we will maintain diversification. It doesn't always work. This chart's too deep. There are periods of time like 2022 when rates rise, so fixed income's down. Rates rise, so the discounted cash flow input to equities goes up, which means the value goes down. There can be very difficult times. That's why little real assets and diversifying strategies will remain in your portfolio to help buffer those periods of time. Okay, so that's it for market. But we're happy to, we'll be around if you want to ask any questions in a little bit, or after we finish, happy to talk more about markets.
Yeah, I think we'll close out just with what we're doing in this environment. So just hearing everything Alan said and just translating it to what we expect volatility. We don't know if the market's going to go up over the short-term period over the year. We don't know if it's going to go down. We don't claim to have a crystal ball, but we do know we try to follow a disciplined process. And it's really 4 things that we're doing, primary things we're doing to protect your assets, your portfolio. You already spoke to the first one, diversification.
I'll finish that because this slide's great for it.
Yeah.
If you squint, you can just tell that there's no consistency in these boxes other than the orange one. And you don't even have to see what it says. That's a diversified portfolio. The rest of these boxes are different asset classes like emerging markets or US or technology, hedge fund indices, a whole bunch of different indices. And they're all over the place. You never know which one. We don't know which one is going to be the dominant. We can't rank order these at the beginning of a year and know the outcome. But what we do know, if you want a more stable experience without all the volatility, the orange, own the diversified portfolio, and it'll stay hopefully a little above average and give you that long-term 8-10%. So that's how you execute the diversification.
Yeah, so that's the big one, and that's most true with that long-term option of your portfolio options. The 3 other things we're doing, one we've already talked about is those dynamic overweights, like we leaned into small cap, we leaned into gold. The 3rd thing we also talked about, is we try to find very talented active managers that can beat the benchmark, but we're very pragmatic about that. Actually, if you want to jump to that slide real quick. And then the 4th thing we do is private capital, which we'll talk about that a little bit, since that's probably the most challenging concept to grasp, and want to make sure you understand how we're doing it.
On the active manager concept, your portfolio has been primarily passive in equities. We do believe that there can be times when active managers add value and make sense. We're likely to rotate some of the equity in the long-term portfolio into some active management, not 100%. There are asset classes where active managers, think large cap US equities, really have difficulty adding value over time. But there's some other areas like small caps or sector specialists that can add value, so we're likely to own some of that. That's a chart that's depressing that shows that most managers underperform their benchmark, and that's gotten worse and worse and worse really since Reg FD came out and eliminated insider trading. Sorry, but I was in the hedge fund side of our research team 20 years ago, before Reg FD, and there was a lot of inside information that wasn't necessarily illegal, but it was shared more directed towards certain managers that had it, and they could take advantage of that. Now that it's a much more fair playing field, and the technology, whether it's AI or just quantitative efforts, and the fast trading opportunities that some of the market makers have, it's taken away some of the ability for active managers to outperform, and we've seen that in the data. So we've got to be very focused and specific on who we allocate to, and we're not allocating to insider traders. I promise you that, because nobody really can do that anymore.
Wait, I might just add one point. Since there was a question too on fees, I think that's a really important point. So we are very, very mindful about only paying for something we really think can add value, either help, just generate higher returns or help with risk protection. And so, with that, your total all-in fees, including us, including custody, and including your managers, are at 0.6% right now on the investment side, and those are all netted out of performance. So that was a question, and we want to be transparent about that, but we will keep trying to keep those costs down.
Two more topics. One, this is what we look for when we pick an active manager. We're investing in people. Most of our assessment of investment managers is built around qualitative metrics of, is that manager in the right part of their life cycle? Do they have the right motivation to generate excess return? We believe investment managers have a life cycle, and there's a right time to be invested with them. Then they tend to lose focus, diversify, get too big, and oftentimes have other people than the real alpha generators making decisions, and you need to get out of that. So we're very thoughtful about who we invest with. At the end of the day, it's people, and we spend a lot of time with them before we deploy any of your capital with a active manager. But let's talk a minute about private capital.
Yeah, sure. You want me to?
Start.
Okay.
Go ahead.
Yeah, I'll start. So private capital is, this year we worked with the committee, with the staff, and the board eventually elected to approve an allocation to private capital. It is 15%, and it's going to take years to build. But I want to make sure you're comfortable with this, because I know there's a lot of headlines, and we do have a strategy, and we do have a lot of experience with this. But I first want to start with why we wanted private capital in your portfolio. And this chart is really hard to see. I'm sorry for you all in the back especially. But what it shows is expected returns over the next 7 to 10 years, and all these different asset classes, including equities, including fixed income, and what we expect those to make. And if you look at U.S. equities, we are expecting those will return annualized a little less than 6% a year. The community foundation, to grow, to stay healthy, and to provide the distributions from its endowment, needs an 8.5% return. So we have to take risk somewhere. And the risk that we chose with the committee to take was really on the private side. Those are above the line. They're expected to return, that the line is the 8.5% target. There, and we still have a good diversification to everything else. We're not saying we're ignoring it. We just added an allocation to those asset classes that are expected to be higher.
And you may ask, or you may have seen headlines, private equity, venture capital have struggled for the last 4 years, especially relative to public markets. A lot of money did move into the private capital space. That increased the valuation on the front end. So if you deployed capital into private capital over the last 5 years, you're kind of flat generally. And the US or the global equity markets are up 15%. So it looks like a really bad decision. The good news is fewer people are putting capital in there because they tend to look back 3 to 5 years and say, is this working? No, I'm taking my money out. That's the short-term thinking money. We're seeing a reduction in money moving in, which creates a better opportunity and a better entry point. So the decision to start allocating now to private capital, we're very confident in. It's a much better environment now. But why, if money has moved in? Well, the main reason you own, and this is really specific to private equity, there's also private real assets and private credit, but in private equity, companies with revenues over $10 million, there's 241,152 companies that are private that have revenues over 10,000 or 10 million, and there's that orange is the sliver of companies that are public. So if you only invest in public markets, you can access this much of the corporate exposure of, this is the United States. You're getting a very small sleeve of the biggest companies. There's a lot of opportunity to invest in these 241,000 companies that private capital gives us access to. It also means there's a lot of capacity. There's a lot of places to put money. So while we had a little bit of an overhang, maybe a little too much money went into this strategy, that's declining, and we're still seeing a lot of growth in private business development and launches that need capital. And at the end of the day, that's what the business of equity investing is. It's taking those with capital, investing that in those that need capital, and will generate a positive result for you giving them their capital. That's what capital markets are supposed to be. Yes, they've turned a little bit into a gambling scheme, it feels like sometimes, but it's about giving capital to those that need it, that are going to give you, hopefully, in excess of an 8% return for the use of that capital. Private markets are now doing that much more efficiently, and we're excited for you to have some exposure there.
This might actually be a good time to just really wrap up and summarize and allow you time to ask us questions about the portfolio or anything you'd like to know. So I would just say, we're excited to have more offerings. That was based on the feedback from you all, so appreciate that opportunity. Yes, as Alan said, performance was really good for the last rolling 1 year. Do expect volatility, and in fairness, we will not always be able to say we're a couple percentage points above the benchmark, but we're very excited that we're able to do that for you this year. So, thank you.
Great. Question?
If you took the chart with the equity returns, and there was way back at the beginning where and put an inflation line on that, how much of that would flatten out?
Yeah, if you inflation adjust, and over the last 30 years, I'm going to guess, when we had the spike, the COVID spike, it's probably averaged about 2.75-ish%. So you could just kind of look at the 14.6 minus 2 point, let's say it's 2.6, let's make the math easier. So you got a 12% excess return over inflation if inflation was 2.6 over that time frame. So yes, it's a direct hit to the dollar value for spending, certainly. And that is in the math that Catherine did to get to 8.5%. Our expectation for inflation for the next decade, we don't have it. It's about 2.75% is our expectation for inflation over the next decade. You got to cover that so that the power of spending today is the same in the future, the same as today, plus the spending that's going to come out of the portfolio to keep that portfolio rising over time. But yes, absolutely, that is a offset to the result.
Oh, there's one there.
Go ahead.
Yeah. How many private equity funds are out there, and how do you go about choosing which ones you're going to invest in?
We want to go back to that one slide?
Sure.
Yeah, we did skip a slide that shows you, we have a very specific strategy that we're happy to share with you. In terms of the number of funds, though, your first question, I don't even know. Do you?
Thousands. You know, 2 decades ago, there were hundreds. Now there are thousands of legitimate private equity funds. And for those, that's how we invest in private markets. We, as the allocator, are not running around the country looking for the business. There are private equity funds that raise money. We like funds that raise money, that raise about 250 million or so. And then they will take that 250 million and invest 10 million or so per company that they have the expertise in sourcing, investing with, and helping grow. So they'll put the 10 million in and hopefully get 20 or 30 million out 7 or 8 years later. That's the kind of generic strategy. And now there are thousands of funds, and we have to be very picky, because just like in traditional long-only active managers, there's a wide dispersion of result from these different funds. The top quartile funds, our expectation over the next decade is they can generate a 15 to 20% return. The bottom quartile isn't worth investing in. Even the median might not be worth investing in. You've got to invest in the right managers in the right part of the market. And for us, that is managers that invest in these businesses that have revenues between 10 and 250 million. BlackRock, Blackstone, Apollo, these are like the publicly traded private capital managers. They invest in these small number of very large companies because they have to put so much capital to work. They're writing sometimes billion-dollar checks. That's a crowded, expensive part of the market. We like to invest with managers that buy smaller companies and then sell them to BlackRock, Blackstone, Apollo, Carlyle, these big, huge pools of money that generally are funded by public pensions and other huge pools of capital. They got to put all this money in this top level. We like to invest in the managers and the companies that are smaller, that then have an exit strategy to sell to these big trillion-dollar firms at a nice valuation. That's the sweet spot for us and our size and you and your portfolio.
So kind of a follow-on question to the private equity, how do you choose it? This is 2 parts. One, how do you see the private equity risk as opposed to the public risk? And 2, what are your hedging strategies overall?
Do you want to take that?
Sure.
Okay.
That's a loaded question, because the risk, the risk's the same in public equity or private equity. It's, are the companies going to generate a result, and are they going to be worth more in the future than they are today? When you look at that chart that shows our expectations, I got to find it. There you go. So one measure of risk, and this is just one of many, is the volatility. That's called standard deviation. When you see a chart like this, this is the expected risk, how volatile the investment's going to be. We have private equity here at about a 17% standard deviation, and that's just on a monthly basis how much up or down something goes. U.S. equity is almost the same. So we think the risk, the volatility risk is about the same, but you're taking a very different risk when you're investing in private equity also, because you can't get your money out. You put money in one of these funds, it's 10 to 15 years before you get your money out. You put your money in the public equity market, you can take it out whenever you want. So you're committing to illiquidity, which is another level of risk. That's why you need a higher return. If you're going to lock capital up, you've got to get a better result than capital that you put in something, and if you change your mind, you get it back. You can't change your mind. So that's a risk that isn't measured on this chart, and why many of our clients, look, if we think this is the highest returning thing, why don't you just put all your money in it? Why doesn't everything go there? Well, because then you can't even take any spending out. You have no availability of taking cash for spending or other needs. So private equity is more risky when you factor in things like that. The unintended but beneficial to what you'll see on these pages in the future is private equity also doesn't get marked on a regular basis. It's quarterly or annual. You know what your NAV is, where public markets get marked every single day. What generally happens then is private markets look much smoother. This 17% is adjusted up. Our real experience in private market investing is like a 5% volatility because they only market ever so often and it's just really smooth. That actually helps a portfolio on paper look less risky, but we are honest with ourselves and with all of our clients. There's risk that you don't see in that kind of quarterly reporting or monthly reporting cycle. Hedging, so we invest in diversifying strategies. You have 8% right now?
Yeah, 8%.
8% in diversifying strategies. That is a category formerly known as hedge funds. We just don't like to say that in public anymore. But it is managers that take little to no equity market risk, but have a return capability through relative value strategies, macro strategies, and long-short strategies. We're extremely thoughtful. I think there's 8 managers right now in that portfolio. They're all a little bit different. Their names like Elliott and HBK, both those firms have been around 20 plus years. These aren't hot shots spinning out of UVA trying to kill the market. These are stable, long-term, a lot of them actually are from UVA, because they do a great job training hedge fund managers there. Stable, long-term performers that don't act like equity markets and don't act like fixed income markets, and we want 6, 7, 8% from them.
Yeah, so I would just add, I know we weren't your advisor at this time, but you were talking about 2012, and equity markets were down 18%, fixed income was down 12%, diversifying strategies was up 0.7% for our clients. So in that kind of environment, that provided a bit of a ballast, and it also provides a place that if you do need to cash, you need to pull, you don't have to lock in those negative losses. So.
Even though we don't want to use the word hedging, out of curiosity, is there still an investment in Bluestem?
Yes, so we are exiting Bluestem. That's actually sunsetting, and it's just going to take time because what's left in the portfolio is actually, we recategorize that as a private capital. And so it's perfectly valid. It's actually generated nice returns for the portfolio last year. We talk to them frequently, and we are building a complementary portfolio around them. So while they exit, we'll have something, that's very diverse around it to replace it.
Leslie, I think we've exhausted the questions for now. Thank you.